welcome to this panel where we'll be talking about farming the future or unlocking climate finance for agriculture. It's nice to see you all in the room, some familiar faces and some connections and acquaintances we've just made today. Agriculture employs most Africans, yet it remains underfinanced. We're told that ostensibly there is a lot of finance in the system, yet that finance is not reaching farmers, is not reaching agribusinesses, and is not reaching innovators. And those same people are exposed to climate shocks. So what we're here to talk about is how capital, innovation, and inclusion come together to drive real productivity gains and resilience. Our panel brings perspectives from every part of the system: private investment, venture, United Nations, inclusion. So I'm delighted to introduce them one by one, very briefly. Starting on my right with Francisco Marquez, who's with the International Fund for Agricultural Development, headquartered in Rome, where he leads their private sector and blended finance work, focusing on channeling concessional capital into partnerships for smallholders and agribusinesses. Moving to Ashish Patel, who's a partner at Avishkar, one of the pioneers of impact investing in emerging markets, where he leads investments that combine both commercial returns and social and climate outcomes. In the center, Désirée Zilan, who's a managing director of WIC Gestion, a women-led impact investment firm focused on empowering female entrepreneurs in West Africa, where they champion gender lens investing as a strategy for growth and resilience, not just as a checkbox exercise. And then from Equator VC, Nijad Jamal, who's a partner. It's a venture capital firm investing in technology and data-driven solutions for resilience and low carbon growth. We'll get to learn a bit from examples in his portfolio as from the other panelists. And then last but not least, Lillian, who's an investment principal at Goodwell, where she manages their inclusive growth investments across Africa. So please join me in welcoming the panelists. So I want to start by setting the scene a little bit. Francisco, IFAD provides concessional finance to drive rural transformation and resilience. You have programs on smart irrigation, in value chains, and you have tried to channel your funds towards productivity gains. Yet we see that yields and productivity remain persistently low, and crucially, post-harvest loss continue to drain value. Why is it so hard to drive climate finance into tangible improvements on the ground?
Thank you, Joseph. Just before I go to your question, just to say that IFAD is really concerned in providing climate finance to be transformational, fulfilling our mandate with to foster rural development and to support the small-scale producers. So on our last replenishment, 45% of our resources are to be allocated to climate finance or climate finance components in our projects. And there's various initiatives, including the One Sahel initiative, which include various projects in sub-Saharan Africa, of which the Great Green Wall, and also one specific project looking on livestock. So we do have a big concern, but trying to respond to your question on why is it not up to scale what is needed. I think also, the main point is that to have an impactful and transformational climate finance, you do need to have an holistic approach and also be context specific. So it's quite difficult to have a one project fits all or one type of investment that fits all that can be scaled everywhere. There's also the lack of partnerships and mobilization of capital that could be improved in terms of synergy and having different partners working together towards this and some other limited other technical limitations that prevent this to be up to scale what is needed.
Thanks, Francisco. You outlined challenges that I think everyone here and in the room faces in navigating investment, in particular in the agricultural sector on the continent. Lillian, if I can come to you with your investor experience, in your view, what makes an agricultural business truly investable? And can you tell us a bit about models that you see boosting productivity and resilience whilst remaining commercially viable?
Yeah, I'll start by saying, so Goodwill, we've been in the investment industry for 20 years. The last 10, we've been looking at investments in agriculture. So to your first question on businesses that are investable, 2 points come to mind. The first one is customers are voting by usage, meaning that there's actually demand for the specific product or service. And that, of course, it translates into revenue. And the second point that ties into that is the unit economics, meaning that yes, the revenue is good, but it actually makes sense from a cost perspective to be in that particular product or service. So it's important that the business is viable. Of course, we want to see the social return, which is very important, but also the financial return as well. So that's to your first question. To the second one, about examples of business models, because we've been in the space for about 10 years, I'll speak of 2 in our equity funds. We have quite a few in Nigeria, in Kenya, in Tanzania, in Rwanda, but I'll speak of 2, one in Kenya and one in Rwanda. The one in Kenya is a women-owned, women-led business. And it's in the avocado oil processing, refined oil. So it's actually a finished product, especially because in Africa, we are often looked at for raw products. So this is really a thumbs up for them. And what they do is that they source third-grade avocados from smallholder farmers. So these avocados would have been thrown away because they can't be exported, they can't be sold locally. And they crush those avocados and produce the refined oil. And then the pomace, they use it as fuel stock in their plant. So a couple of different sectors have been touched there. There's a circular economy, there's agriculture, there's post-harvest loss, so there's export. So it's so many sectors coming into play. The second opportunity that's also a good business model that we are seeing is in Rwanda, and they do production in agri as well. And what they do is they produce tender stem broccolis and fine beans, and they use smallholder farmers and their own farms. And how they make sure that the yields are good is they work with different service providers for capacity building. So really making sure that the land and water is being used efficiently. So touching on, and they export these products, and some are used locally. So they're touching on food security, touching on export, touching on climate smart practices, so quite a number of different things. So you can see there's the viability of the business model as the social return side, and there's the environmental side. So those are the 2 business models that I feel would be good ones to look at.
Thanks, Lillian. Those are really great and encouraging business models and organizations that are being successful commercially. Francisco, if I can just come back briefly to you, given the vantage point where you are, if you could change one thing about making climate finance work for resilience and productivity, what would it be? Is it about how risk is shared? Is it about blending capital? Or is it about coordination and how partners come together to execute?
Yes. to really have the transformation, not only one, there's of course the macro level. So if there's more funding being channeled, more political will, that would definitely, and also the reduction of the red tape and the level of requirements that is needed, that will be much more impactful. But if just one could be changed, I would definitely think of the products that are more adapt to the reality, to the needs of the entrepreneurs. So lower tickets that allows them to access with requirements that are not in terms of certifications and that are cumbersome or are not feasible or too expensive. So if it's only one, definitely to have products that really fits the necessity of the entrepreneurs.
Thank you, and I'm sure that's music to the ears of any entrepreneur. Thank you very much, Francisco. Shifting gears and moving towards this idea of innovation and scale, Ashish, I want to bring you in. When we last spoke, you said how there's this false dichotomy where investors often separate the goals of inclusion, wealth creation, and climate resilience, when in practice and in reality, they actually, they're unified, they succeed or fail together. So from your perspective, where you've backed cold chain logistic ventures and climate smart input suppliers, how do you bring and support investments or design investments that support that single strategy that's building both growth and sustainability in the long term?
So I'll just talk about sustainability firstly, right? Because I think Lillian's example is a great one where whenever we're evaluating businesses, we don't tend to silo definitions, because I think there's too many consultants around who kind of say, what's climate? Climate is carbon. Well, actually climate, can be carbon, it can be soil, quality of soil, retaining quality of soil, it could be water, resource utilization. So when we look at investing, we kind of go through a couple of filters. The first filter obviously is through our impact lens, right? Because Avishkar is all about impact. What are the goods, services, or livelihood enablements that we're doing for the 3 billion that don't have access to that today? The second filter is obviously around the environmental and social outcomes. So we prefer to use the word environmental and social outcomes because for us, climate is part. So giving you an example, we recently made an investment in a macadamia nut factory. They're processors, but they're doing backward integration into growing macadamia trees on derelict land in central Kenya, which is deforested because of coffee plantations and other things. Now that in itself technically is carbon sequestration, but we don't look at it from that perspective. We're saying that you're actually having an output which is useful, they have customers, people want a product, and then how do you kind of integrate that back into climate resilience, right? And then the third thing is financial viability. So if any one of those don't hit, especially the third one, we don't do it. So financial viability for us is, if it's on the equity team, it's around, are we delivering a return that our LPs are expecting for equity style investments? If it's a debt product, are we getting those sorts of returns in a sustainable way? And at the same time, producing outcomes that are good for climate or resource, not as resource intensive, to ensure that there is a long-term viability of this. And then obviously within that, the livelihood angle comes in, because you're creating jobs, you're creating quality jobs, full-time jobs. That's the ultimate goal from an impact outcome for us.
Yeah. No, thanks. That's very succinctly put, and I like the fact that you call out the fact that people need to generate wealth, and you can achieve that at the same time whilst growing businesses and making them successful and profitable and returning value to the investors. I think we'll probably have a chance to come back to explore some of those themes in more detail. But I want to bring in Nijad. Being 2025, I think it would be remiss not to bring up technology. So I'd be keen to hear from your perspective what you see in your portfolio and in the ecosystem, what sort of technological solutions you see that are driving productivity gains and also proving that you can have resilience concurrently with growth.
Yeah, I mean, I think the reality is that the agriculture space is just inherently a physical space. I mean, this is, literally in the ground, it's a physical space. There are operations, there are logistics, there's farmers, but the good news is that, there have been technology tailwinds, I think, over the past several years that are allowing us to think about where technology and digital layers can come into more traditional value chains to create either more affordable goods or services, or create access to more novel mechanisms of getting kind of products to market, for example. And so it's no longer just about business model innovation. There is actual technological innovation. And thanks to anything from sort of reduction in prices of solar panels or batteries or cold storage, improvements in data and connectivity, allowing you to kind of be more present on mobile phones, and that sort of creates new market opportunities, new technology opportunities, or even things like geospatial imagery and satellite technology, blockchain technology. And so these sound far-fetched in a sense. I mean, as sort of how does that connect to some of the more traditional agribusinesses that we are so familiar with? But we are seeing, we are seeing, parametric insurance for the climate space. That's coming out of advances in satellite technology and geospatial imagery married with actuarial science that allows farmers, smallholder farmers, to access climate insurance in a much more scalable, much more affordable way. Or similarly, using that example of geospatial imagery or satellite technology, we're able to now measure changes in soil organic carbon content, to think about how soil can be used as a carbon sink for sequestration, but also how to inform farmers about better land management practices, to improve yields and to have greater output from the sort of the soil and the inputs that they have. I think even GIF is an investor in a similar type of company. Or on the other side, we talk about post-harvest losses, we talk about market connectivity, but now we are seeing farmers being connected to blockchain technology, digital ledgers that are allowing us to digitally trace all the way from an individual farmer all the way to market, which batch of cocoa, or which batch of whatever product or crops that we're seeing, all the way through a value chain, and then to use decentralized finance to help improve access to capital in a way that otherwise was never affordable. So there are technology layers and innovation layers that we're seeing that I think are creating the space between physical and digital. The expression is phygital, but that is kind of, it's a terrible expression, whoever came up with it, but it does tell the story that is sort of, I think, the next phase of maybe unlocking climate finance for innovation in the space.
Thank you very much. I have a couple of follow-up questions for you both. Ashish, what do you see as, you mentioned a bit, your focus on whether it's debt or equity investments, the expectations on returns, but what would you say are the make or break factors that you look for before investing in a growth stage organization?
So it's really the same that I think we've always talked about, the quality of the management teams, and actually it's manager, because normally they don't have a team at this stage, it's a person. And then we put a lot of emphasis around what we call internally intentionality, right? Meaning, yes, he wants my money to do whatever growth, but is he or she committed to my aspirations around environment and social outcomes as well, right? Do they see the benefit? And then we don't stop at the question, we actually ask for demonstrable proof. Now, of course, you've got to take in mind they don't have the money at that point, so they may not be able to have a full E&S management systems, but have they done what they could have done within the resources that they have to show that they were intently doing that on conscious? And then followed by that, we kind of then put the other filters of, how long has a business been around? Is this manager committed? So we don't normally look at businesses that are less than 3 to 4 years old, because we want to see that manager has actually put in sweat, blood, everything that he has into trying to grow that business to the extent he has. Because bear in mind, a lot of our businesses, we are the first institutional capital going in, whether it's equity or debt. So we want to see that. And then the robustness of the financial model that follows is another important aspect of it. Another thing that Lillian talked about, which is really critical for us in the agri space, in most of the export spaces, have they got real customers that have been repeat customers? Because customers actually are a great litmus test on the quality of that person, because mostly international customers require specific standards, they require specific level of quality, credit, all that stuff. So it kind of sieves out a lot of the I think I can do this versus I know I do it, right? So that's what we tend to.
Thanks for that. Nijad, really briefly, where do you see the biggest opportunity for both innovation and capital coming together to drive climate smart ag?
Yeah, I think the interplay between capital and innovation are sort of, it's clear that they play off of each other. Without innovation, capital is not moving in that direction, and similarly, innovation requires capital to support it. If I think about an example of a company in our portfolio, we've invested in a company that provides solar-powered drip irrigation to smallholder farmers. Well, they needed equity early days to fund R&D and technology development and to cover OpEx. Then they needed working capital to support with inventory. Then they needed asset finance against certain assets. Then they needed results-based financing to help bring down the cost of the end product to make it more affordable for the end user. Then they needed carbon finance to be able to kind of support again with greater access, bringing down price points, improve margins. Then they needed, then they needed grants and technical assistance to help with new market entry and to access, underserved populations, female populations, different. So we have a list of capital: equity, debt, working capital, asset finance, carbon finance, results-based financing. The list goes on for one of these companies to try and scale. It's both the challenge and the opportunity, because ultimately, for that innovation to get put into the hands of customers, we need many different types of capital, and we need a lot more collaboration in our ecosystem between the different providers, a lot more nuance, because ultimately, equity alone and early stage equity alone is not going to be the solution on its own.
No, thank you very much. Desiree, thank you for your patience. Want to bring you in on a key topic for a lot of people in this audience, which is about inclusion. So, as I mentioned in introducing you, Week Gestion invests with a gender lens, and you have cooperatives in agri-food processing, SMEs improving market access, and you've shown how this can unlock community wealth and performance. Can you tell us a bit how you go about identifying these women-led agribusinesses and support them on a pathway to resilience?
Thank you, Joseph. I was about to go out because I was thinking I will not speak here. Thank you for that. Well, now addressing your question and building on what you just said about the opportunities in financing in the sector. When I came here today, I was reading a newspaper and I saw that the African Development Bank said we need around $2.5 trillion in climate financing for agriculture in Africa by 2030, while for now we are just having $44 billion coming in yearly. So you can see the gap is huge, is more than 100, 200 folds what we need right now. And the opportunities are there. When we started with Capital in 2020, inclusion wasn't about having to tick a box on a corporate social responsibility or a part of a fund, ESG model that we had in mind. The point was to make inclusion a feature instead of just an afterthought of investment strategies. And the point is quite simple. 44 billion pouring in Africa in agriculture and climate finance every year, and 90% of those amount goes to the top five, so the top four, the big four, Nigeria, Kenya, Egypt, and South Africa. So that leaves 10% for the rest of the continent. Imagine less than 1% for Francophone West Africa where we invest. That means that we really need to step up the game when it comes to financing those businesses, and especially when we have a gender lens to it. Now, the issue is in the agricultural space in those countries, 60% of people working in that space are women. They are the ones to transform the crops. They are the ones to be the small farm holders. They are the ones to provide to the corporations willing to invest in manufacturing on the continent. So investing through gender lens in that space creates three things. The first one is to have resilience, to build resilience. When you invest in those companies, you build resilience for the value chain. The second thing is also to invest where the women are. When you invest where women are, the impact is twofold, threefold on the general population, because they are want to multiply the impact on the society as a general. Not saying we don't do as men, but they do it better. And the third thing is actually channeling the money to where it should be. So let me give you an example if I can. One of our key portfolio companies is Mburu. They transform local cereals, so millet, sorghum, into pastries. This is something they've spent quite a time on researching and developing how to do that, while before that in Senegal, most of the pastries and bakery were based on wheat, which is imported. So when COVID hit in 2019, 2020, there was a huge issue about importing, and Ukraine war came in, knowing that 90% of the wheat was imported from Ukraine. Then you have a double issue. Now, you have millet, which is very nutritious and a resilient crop. You have sorghum, you have maize, all those local cereals that don't need much water to grow. And then you have people importing and using foreign exchange to import wheat, which we don't naturally need to do pastry or bakery. So Mburu has been doing this, and when we invested, now they are 8 times their revenue in 2 years. So those are some kind of examples that we are working on, and we intend to work on in the near future to address those challenges.
Thank you, Desiree. Your statistics sort of brings into sharp relief various sub-challenges. So there's the financing gap. Then there's the layer that perhaps that financing is rather Anglo-centric, for lack of better word.
Yeah.
And then on top of that, or further to that, it's not flowing towards female entrepreneurs.
Yeah.
So I really want to probe you on this. How do we, try and go beyond this checkbox exercise and really, is it about presenting data about the impact that female-led businesses have on their community and how their businesses are just as productive. How do we shift this paradigm so that investing in women is seen as a strategy for competitiveness and growth, not just a nice additional thing to have?
Yeah, I think we need to think it differently. It's been 5-6 years now that we are presenting these data and what our investment is having as an impact on those female entrepreneurs. And we saw growth in how it's shifting the thought process of most of the investors, including the DFIs. But I think the most important aspect is to show that it can work, commercially speaking. Because we can talk about impact the day long, but whenever you're talking to the investors, they will talk about market rate return, which I understand perfectly. And the point is, impact is not the antonym of market rate return. And our investments are proving that you can have impact, and then you have more than the impact, the market rate return at the same time. And I think this is how we can shift the focus to make them invest more.
Thanks, Desiree. Lillian, I want to bring you back in, because Goodwill also looks a lot at inclusive business models. So can you tell us a bit about what you have learned in your experience from gender smart or gender sensitive investment?
Yeah, I like the idea you shared earlier of putting out some data on how investing in women, how it looks like in terms of the financial return and social return. I don't think there's any report out there that's really captured that data. It'd be good to see that. So speaking of data, one of the equity investment that I mentioned that does avocado oil processing, we invested in her. It's women-owned, women-led in 2021. And now revenue is over 7.5x grown, profitable since 2023. So, I mean, that's data right there. So what we are seeing, so what we invest, we make equity investments, we do mezz debt investments, and we also do debt investments. So right now we have a project mandate with the GIZ EU, where we are looking at investing in women-owned, women-led businesses across Mozambique, Malawi, Tanzania, and Kenya. And so we have a seat at the table in these businesses. And so we really get to see how they bring the same energy, the same experience, different perspective, different ways of doing things, and still looking at balancing that financial viability and return side of things. And so that's how we see, it's important to be very intentional about when you're looking at investing in women, to actually invest in women, not for the tokenism of it, but actually looking at the ones that are moving the needle, and not just from a social return angle, also the financial side of things. So this particular mandate that I'm talking about, the intention and the end goal is to catalyze capital to specifically women. And so the instruments that we deploy are concessional loans and guarantees. Now, why guarantees? First, why concessional loans? Because the cost of capital is lower. We don't ask for collateral, the things that challenge women. And then the guarantee side of things, if you look at Mozambique, the businesses there can absorb little money. And so the way this guarantee is structured, it enables to de-risk the business to the local banks, and therefore catalyze capital to the women whom they would not ordinarily have invested in. So that's what we've seen so far. We keep trying to see how we can bring more women, finance more women, and bring them more onto the table. But because we have a seat at the table and we are hands-on, we also get to see them at the board level, committee levels. So we can do that comparison when we're looking at women and men and say, actually, it's the same energy, same experience. And because women can be a little bit more detailed, in a startup, it allows them to look at the various parts of a business that are open at the same time. So that helps.
Oh, thanks. And it goes back, excuse me, thanks, Lillian. It goes back to the point Ashish made that management and the people ultimately are the ones who play a very big role in determining the success, probability of success of these organizations that we support. For this final segment of the panel, before opening it up to the audience, I wanted to give you each, an opportunity for a final remark. I'm struck by the optimism. You're just seeing solutions left, right, and center, but the progress is not, where there's not enough coordination. Perceptions of risk are what they are. How do we shift the needle from your different institutions? I think it would be great for the audience to hear. And I'll start with you, Francisco, and then go across.
Definitely, this is already a first step to understand what the others are doing, how we can partner, how we can support, what works, what doesn't work, have lessons learned. So constructively discuss honestly and try to come up together to have approaches that are, as I mentioned, holistic and country or context specific. It's, I think, a first step towards a lot of progress to be done.
Nicely put, Ashish.
I think that's a difficult question if you ask me, but I think, one of the things we're doing is we're learning a lot from the success models of Asia and trying to understand why Africa, or what we need to change in Africa to be able to. So Asia, particularly if you look at countries like India, largest population in the world, has moved from being a net importer of food in the 70s to a net exporter and one of the largest exporters of food. And you ask the question, what did they do that we're not doing as a country, right? I mean, we talk about Africa as if it's one country, but it's actually not. I mean, and I think the coordination between government policies around priority sectors, agriculture being one of them, and we're very keen on agriculture because we see it as the fastest way to bring livelihood changes on the continent. To simple things around storage facilities for post-harvest losses, which you brought about, which doesn't exist in Kenya today. Whereas these are facilities that are government-owned, backed across India, which allows farmers to do factoring of their products, which is, again, a very quick way to bring wealth creation at the farm levels, and making large state banks have certain percentage of their lending books going to those sectors, right? So they don't have a opt-out, which forces them to look at new businesses, right? So creating ecosystems require some form of regulation, but it just seems that our governments kind of miss that. And I think if there was one thing, silver bullet that you could bring about, that would be one of it.
Yeah, no, thank you for the candid thoughts and also that nice compare and contrast with India from a policy and government perspective. I think it's pertinent. Thank you. Desiree?
Yeah, so I just have one word. It's local capital, in my perspective. Only when you know where it's scratched that you can address the issue. When we started We Capital, the foundation was to raise local capital. We have the first fund, but 20% of that fund was raised as local capital at first. Why? Because building upon local capital is the key to address to channel the financing to where we really need it as a country, as a region, and as a continent in general. When you start investing somewhere and people say that it's working, then they will pull in eventually and come in with the capital from abroad. And the second thing is maybe to continue talking about it. We need to talk more, maybe when presenting the data and having those kind of conversations and collaborating, that will help to convince the others to join us in doing what we are doing on the ground.
Thank you, Desiree. Nijad, over to you for your final thoughts.
Thank you. I think for me, in the path to scale for many of these kind of agriculture companies or even agriculture ventures, we need to continue to think about using the right types of capital for the right use cases. And so grants or technical assistance where that's relevant, blended finance where that's relevant, working capital or debt or equity in the right use cases. Those that can be more patient can play a certain catalytic role. Those that have to be more short-term minded are going to play a different role. And if we coordinate better and create more nuances in terms of the different flavors of capital, I think then we have a chance to really see companies and ventures scale.
Thank you. And Lillian?
Nijab said exactly what I wanted to say, which was that, different financiers play a different part on the chain, from grant to equity to debt to exit. So as collaborative coming together really can move the needle for that particular business. But because he said that, I'd like to say another one that was on my mind, which is how the different sectors coming together can really complement each other. So for example, in agriculture, finance and energy are very important. So how those three come together and how they can find a way, maybe the associations, to find some kind of ecosystem or collaboration can really help to assist to move the needle.
No, thanks. Thanks to the panel. Brilliant.
Like-minded.
Brilliant reflections around the coordination problem, the policy environment, which I think sometimes we are naive about, maybe, or we need to up our game in terms of really dealing with some of those binding constraints. Of course, involving local finance, it's a big area of work that the DFIs as well, amongst others, are looking to support. But it has to, locally led solutions should be financed with local flavor of capital. And to the final 2 points, excuse me, about the intersectionality of the work across different sectors, as well as the right instrument at the right time. These are all pertinent questions, so pertinent concepts that I hope the audience will take with them. And sorry we didn't have time we're just 1 minute for a Q&A, but just can you please give a round of applause to the panelists. Thank you. You've got? We're at time. Yeah. Can we allow?
We have a small break, so I can give you 5 minutes.
Okay, sure. I think a couple of people raised their hands, so we'll start here with Ruby, then we'll go to the back, and then we'll come to the side of the room. So. Please mention your name, your organization, and who you're addressing your question to.
Okay, my name is Ruby. The company is called Supiva. We're a gender lens impact investment advisory firm. Supiva is short for supporting the divas in Africa. My question is actually not a gender question, but this goes to the entire panel. We work with a lot of agriculture firms, and when you talk about climate finance, half the time they're more concentrated on growing their coffee, growing their beans, growing their horticulture. And they're not so sure what is these fancy words, regenerative agriculture, climate smart agriculture, climate adaptation, climate mitigation. What are these fancy words even mean? So I'd love to ask all of you who've been investing in climate finance for agriculture, how are you supporting your pipeline, number one, to be more climate smart or climate effective or climate efficient, whatever it is that you want to call it? And secondly, how can we support, like how can we actually work with these agribusinesses to be more climate aware? Because at the end of the day, they just want to grow their tender stem broccoli. They just want to grow their coffee beans, you know? So how can we help them and work with them so that they can be more climate, fill in the blank?
Thanks, Ruby. Can we gather the questions and then we'll have the panel answer. The gentleman in the green jacket.
Thank you very much to the panel. The name is Nvisita Dube from Zimbabwe, representing horticultural farmers in Zim. So I just realized that you mentioned most of the things that resonate with me, particularly adaptation finance. I'm very much interested in understanding, there were examples that were given like the Asian cases and so on, and the utilization of a guarantee in order to appease the bankers. I'm very much interested in understanding if you have looked at alternatives that would allow financing to flow, particularly into adaptation finance. Alternatives that do not naturally speak the banking language. I'm speaking of something similar to the Grameen model in Bangladesh that allow other methods of vetting, that allow other methods of agreeing that this person is worthy of financing or this business is worthy of financing. They would take the form of some form of rating, for example, or some form of a certification that this person or this is trustworthy, this is a space that we can actually invest in. The challenge is the private sector stays out because of risk. So is there another way of de-risking the smallholder farmer, the communal farmer, besides the guarantees, the collateral, and so on? I believe this would allow financing to flow easier, but I just want to understand, mostly from Ashish, could we have technologies that could give a rating to a farmer such that if they had this rating, they are better off in a position to get a loan?
Thank you. And then the gentleman at the front.
I'm John Shikatana from Pangaea, Africa, based in Ghana. My question concerns this financing gap, the $2.2 trillion climate smart agriculture financing gap. Devin Chesney from Aspen Institute recently said the financing gap is fictional. And what he meant by that was that until we have a pipeline of businesses that are ready for investment, the real limiting factor in bringing more capital to agriculture is really the readiness of companies. And so I'd just like to hear your comment on that. Do we need more innovation? Here, of course, understandably, we talk a lot about the supply of capital, but on the demand side, are we doing enough? Do we need more innovation? Do we need to focus considerably more attention on supporting readiness of companies so that we can move more capital? Thank you.
Thank you very much. Those are three excellent questions. One on demystifying the language, the other on alternative forms of assessing agribusiness suitability in order to attract more finance, moving away from more traditional lending models. And then finally, the question around pipeline. Do we actually have a pipeline that's ready and investable and bankable if Mr. Chesney is indeed accurate in his assessment? I'll take volunteers for...
I'm happy to jump in on the first question. I think the second was addressed to you. I mean, this is a very personal perspective, but I think we are climate-focused investors in a region where I think the concept of climate sometimes is a luxury for our customers. Our customers care about their lives, their incomes, their yields. They're not necessarily, and I'll caveat that with a very generic statement, but not always kind of saying, oh, climate change is top of mind. So if we can support a customer with insurance insuring them against a risk of climate change, they'll buy insurance if they see the value in that. If we can help them with more improved irrigation techniques and that saves them water or that saves them from petrol pumps or whatever it is that they have to do, or if the post-harvest loss, it's a nice word that we talk about in conferences, but at the end of the day, someone is saying, how much am I getting paid for the product that actually ends up in the market? And so if we're supporting them with goods and services, the conversation doesn't have to be about climate change. The conversation can just be about ultimately, improved yields and improved income, and the improved, even the concept of resilience is a fancy word. They just know if this doesn't happen, if there is a drought or excess rain or not enough rain or whatever happens, I'm going to get paid. I think that speaks for itself.
Thank you. Over to you for the question kindly addressed from Zim with love.
Yeah. So I think the quick answer is, I think there is a path. It's a long one. And if you look at what Asia is doing, in particular India, is the introduction, for example, of 2 or 3 key policies that government started with over 10 years ago. One is the digital identity for every resident of India, not citizen, but every resident of India has to have a digital identity which attaches him or her to everything that he or she wants to do within the country, right? So that's the beginning of a credit record and a bank account that can automatically be opened if you have that digital ID. A bank cannot refuse you a bank account if you've demonstrated you have a digital ID. The second is the policies that they've come out with, banks having to lend to what they call priority sectors, right? So the SMEs get access from the larger banks, but a second priority sector that they've identified over the last 2 decades is NBFCs, non-bank finance companies, which automatically become very regionalized and very sector or specific in what they do. They could do truck financing, they could do agricultural financing, or they will do financing in the city of Harare only, as an example. So what you're forcing that to happen, a forcing function is banks lend to NBFCs, NBFCs do forward lending, but they're supposed to know the community in which they're lending, and therefore it may not be the Grameen model directly, but it's the next version of the Grameen model. So I think all of this ecosystem needs to come together. And then what we have done as Avishkar is that we financed India's first agri-tech company, where we were able to address farmers directly through a technology platform, giving them farmer inputs and taking outputs as pre-selling their outputs, right? So we're giving them some level of comfort, but basing it on the back of the digital identity so that we actually know where the farmer is. He's a legit person. And that starts a credit system by attaching our platform to banks. So that hasn't started as yet, but the intention is that over the longer run, that's how you can access the personal financing. By the way, farming financing is not an emerging market problem only. It exists in Europe and in the UK. It's just that governments subsidize it a lot. So just
Thanks. And 10 seconds, is pipeline fiction? Is it a pipeline issue or is it a finance issue?
Both.
Exactly.
Okay, that's a diplomatic response. I see Desiree nodding and Lillian as well.
No, it depends.
Okay, go for it.
It depends, because it depends on if it's early stage, there's a lot of pipeline there. If it's later stage, there's not as much pipeline. So the early stage need finance. There's finance in the later stage, but no pipeline. So it's the opposite.
Inverse.
It depends.
So we need a bridge. We need to create more funds to address the, let's say, not so early, but not so late stage mature companies. We need to take them by hand to bring them to you for later stage finance.
Thank you very much. Thank you.